Hi, Gabriel Josiah here. In this section, we are diving into net assets turnover ratio, a powerful metric that shows how well a company uses its net assets or equity to generate sales. This ratio is essential for evaluating operational efficiency and capital utilization, which can boost profitability and shareholders' return. Let's unpack how it works, why it's critical for both exams and real-world application, and how you can use it to assess a company's performance. Let's delve into it quickly. Let me share my screen like it's our custom to look graphically into this ratio. And see my screen now visibly on the net assets turnover ratio. So this ratio measures how efficiently a company utilizes its net assets to generate revenue. Net asset refers to the total assets minus total liabilities, essentially representing the equity invested in the business. This ratio helps evaluate how well a company uses its equity or capital to generate sales. And the formula is sales as the numerator divided by the net assets or the capital employed. This measures a rate at which net assets or capital employed generates sales revenue. So the formula is net assets turnover, or the formula for net asset turnover is net sales or revenue divided by your net assets, or your net sales divided by capital employed, where we have the total revenue from sales activities as our numerator, and we have net assets as our total assets less our total liabilities, or equivalent to our shareholders' fund or shareholders' equity. Okay, let's calculate this graphically with our example on Shalubutu Nigeria PLC. So we have a constant, which is our sales revenue from our statement of comprehensive income as our numerator. So we'll take that. If you're using your calculator, just follow me. We'll take the sales revenue. Now let's go get our net assets, which is in our statement of financial position. So we have our total assets here. So we pick for the ending of the year. This is important. So we pick for the ending of the year, which is 1,595,000,000 naira as our total assets. So our total assets is 1,595,000,000 naira. Okay, so now let's go get our total liabilities in the same SFP. So we have the total liabilities as a figure of 900 million. 900 million naira. So let's pick that. Take to our Excel. So if you're using your calculator, you just take that as the denominator, or the denominator, of course, we're having both of them as the denominators if we get the difference between the total assets and the total liabilities. So let's have our net assets right now. as our total assets minus our total liabilities, which will give us our net assets. So our net assets is 695 million naira. Very simple to calculate. So now we have our net assets turnover ratio to be our sales revenue divided by our net assets. Very simple. We have it as 2 times. So we have it as 2 times. Sales revenue covers your net asset twice, which in my opinion is good. Positive figure. So let's go back and see what this means. So it means the net asset turnover ratio shows how many times a company can generate sales from its net assets during a period. A higher ratio suggests, like we've seen just now, of twice and above, that the company is efficiently using its net assets to drive revenue. While in contrast, a lower ratio indicates that the company may not be fully utilizing its net assets efficiently. And the implication is that a higher net asset turnover ratio is generally favorable, as it indicates that the company is efficiently and effectively using its capital to generate sales. A lower ratio could signal inefficiency in utilizing the equity base or capital structure, leading to lower return for the owners of the business or investors. What is the cause and effect? So where you have a high net asset turnover, the cause is effective use of equity, strong sales performance, effective management of capital and operations. That's the cause of a high net asset turnover. And the effect is higher return to the shareholders of the business, improved profitability, and better overall business performance. Conversely, lower net asset turnover is caused by poor asset utilization, weak sales or revenue generation, underutilization of capital or net assets, overinvestment in non-revenue generating assets. So these are the cause of low asset turnover. And the effect is clear. It reduces returns to shareholders, lowers profitability, and potential underperformance in the market. This is critical. So in conclusion, the net asset turnover ratio is an important measure of how well a company uses its net assets to generate sales. A higher ratio reflects efficient capital management and strong sales performance, while a lower ratio indicates inefficiencies that could impact profitability and shareholders' returns. It's necessary for management to optimize asset utilization, which can significantly enhance business performance and also shareholders' value. So as chartered accountants, it's our job, and the onus is on us to ensure optimal use of assets, thereby culminating in enhanced business performance, providing shareholders value. This is key for every business and for every accountant. Value creation is necessary and expedient to ensure that shareholders smile to the bank at each year's operation. Okay, thank you very much. Having looked at the net asset turnover ratio, we've seen that it offers valuable insights into a company's efficiency in utilizing its net asset to generate revenue. A higher ratio indicates effective and efficient capital management, and a lower ratio shows or highlights underutilized assets or inefficiencies, which is very clear from the example we've just seen. Very practically. All right, thanks for watching. Don't forget to like, subscribe, share with your friends and colleagues, and stay tuned for more practical financial analysis tips, whether for exams or career growth. Mastering these ratios is your key to becoming a well-rounded finance professional and a chartered accountant. See you in the next video. Until then, bye for now.